There's some big institutions lightening their portfolios, dumping billions of dollars into the market, but they're doing it in a controlled way. The market drifts a little higher to resistance. They unload, a few $100 million or $1 billion worth, drive the market back down, then they stop selling. They let the market repeat that. And we saw that all last week. So these are early warning signs that these huge institutions are starting to lighten their portfolios, reduce exposure, and they take months to unload portfolios. So all it is an early warning sign, along with other things. Gold and silver and miners are telling us that, I think we're very close to some type of black swan event, to a recession, to a big stock market reset. Obviously, oil taking off, all these things we'll touch on are leading to, I think, a bigger bearish picture for the economy and the equities markets.
Hi, and welcome to Wealthion. I'm James Conner. Well, here we are in the last quarter of the year, and there's so much happening in the world. The financial markets are showing no signs of weakness. The S&P is making new highs every other day. Every central bank throughout the world is cutting interest rates with the hopes of stimulating economic growth. So do we just keep riding this wave until it breaks, or should we take a more defensive stance? To help answer this question, my guest today is Chris Vermeulen of the Technical Traders. Chris, thank you very much for joining us today. The last time we spoke, it was early August when global markets got hit. The S&P was at 5,100. Now it's at 5,700. And at that time, you were a little bit concerned and thought the market was topping out. But here we are 2 months later, and the market's much higher. And as I mentioned, this S&P continues to make new highs every other day. And we recently saw a very strong non-farms number last week. And before we start looking at the charts, maybe you can just give us your view of the big macro picture.
Sure. Yeah. Well, thanks for having me, James. Overall, like when I look at the big macro picture, kind of the overall view of what's going on, I believe we are getting closer and closer to a major market reset. But as you just stated, the market is still in a very strong uptrend. In fact, that August shakeout that you and I talked about and we're experiencing in our last talk, and the volatility that we've seen has really kind of cleansed the market. When the market has a sharp pullback and a pause, a couple month pause like we've just seen across the board, it re-energizes the market that could have another push higher. So I do think overall equities have another 3 to 8% upside on the SP 500 or the NASDAQ if this traction continues to follow suit. But in the big picture, I do feel like things are starting to slow. I think we're seeing, unemployment slowly creeping up, although it did dip a little bit last week. But we're seeing delinquencies on credit cards. Cards are maxed out and they're going delinquent. I think it's one of the largest times ever we've seen maxed out credit cards that are delinquent. A lot of people will just have small amounts of debt and just not want to pay it, but cards are maxed out. We've got residential, commercial real estate, mortgages are starting to default and take off. We've got a lot of defaults starting to happen actually in the multifamily, which is like not a good sign at all because that's the most affordable to build, has the most potential. So there's a lot of stuff behind the scenes unfolding, telling us that, people are running out of money. People aren't finishing projects. Everything's costing more. And we're seeing like leisure and activities we've seen some of the biggest cuts in that area. People just aren't spending the same amount of money as they used to travel. All kinds of discretionary products are coming to a grinding halt. And we've seen the biggest layoffs in that space. So when people start closing their wallets and tightening up, it's going to take a few months, a quarter or so, but it'll ripple through. And we're seeing, cut in manufacturing, which manufacturing is like 3 or 4 month lead time. They're not getting the orders from the stores, so they're laying off employees. So there's a lot of stuff coming down that by the end of this year, I think we could be like, getting very, very weak in terms of recession being a lot clearer down the road. So that'll tip the scales and make people even more nervous. And it's kind of a self-fulfilling prophecy. I think we'll see equities and things sell off and go from there. So I'm short-term bullish, but longer term, I see the music coming to an end.
Okay, so why don't we start looking at charts, and why don't we take a look at the S&P to begin with? It's up 20% on the year, and it's currently trading around 5,700. You think there's another 3 to 4% upside?
Yeah, I think there's still some pretty good upside. I like to use Fibonacci extension as a technical trader, which gauges how much momentum there is. And this big correction that we saw back July, August, if we use a Fibonacci extension, which I find is the most accurate tool to project upside targets, I only use two measurements on this. I use a 618, so meaning this rally and this pullback, if the market rallies 61% of this first leg here and takes a pause, which it has, we almost always go up and hit this 100% measured move. So there's about 4% upside here on the SP 500 to the upside. The NASDAQ has about an 8% upside potential based on its chart pattern, but it's this whole consolidation right through here where the VIX spiked like 175%. We saw all kinds of fear. When the market has one of these fear-driven events, it cleanses the market. Anybody who's going to get shaken out got shaken out. That's what all of these are. This one isn't quite as severe, but it led to the next major leg up. And of course, this is another one of these little pauses. The smaller they are, the smaller the potential upside. But when we have one of these big ones, it can push the markets to have a pretty big move. But we're definitely seeing some warning signs. All last week, we saw distribution selling on the indexes, meaning every time the market drifted higher on light volume, we'd see heavy volume step in and hammer the price. There's some big institutions lightening their portfolios, dumping billions of dollars into the market, but they're doing it in a controlled way. The market drifts a little higher to resistance. They unload, a few $100 million or $1 billion worth, drive the market back down, then they stop selling. They let the market repeat that. And we saw that all last week. So these are early warning signs that these huge institutions are starting to lighten their portfolios, reduce exposure, and they take months to unload portfolios. So all it is an early warning sign, along with other things. Gold and silver and miners are telling us that, I think we're very close to some type of black swan event, to a recession, to a big stock market reset. Obviously, oil taking off. All these things we'll touch on are leading to, I think, a bigger bearish picture for the economy and the equities markets.
Yeah, well, to your point, it's going to be interesting to see. We're going to start seeing Q3 numbers coming out here in earnest in the next couple of weeks. The first big one is JP Morgan at the end of this week. And it's going to be interesting to see the narrative coming out of these companies, just in terms of the consumer and the health of the consumer. So just to recap here, your short-term target on the S&P would be 6,000 by the end of the year?
Yeah, roughly about 6,000, yep.
And why don't we move over to the NASDAQ now, and let's get your thoughts on that. It's also up 20% on the year, but it's not making new highs like the S&P is.
Yeah, so it's struggling a little bit more. Obviously, the masses always pile into the big Magnificent Seven. Whatever is in the news and moving, for some reason, the masses all want to own it. And so when the market starts to correct, they all dump the same stocks. So the NASDAQ really got hit and people are nervous. We saw like a 20+% drop in the markets and Nvidia. But we have seen, a rally. We had a pullback, and now we're playing around this 618 level, and it's got about enough to go up to about 21,000, or pretty much a double top for the NASDAQ going forward. So there is still upside potential, but definitely there's been some damage done. People who were involved in the Magnificent Seven really went for a roller coaster ride, and now they're a little gun shy, and that's why we're not seeing it go high. Making new highs like the SP 500. It's just people are nervous and they're worried that it's going to be another collapse. So this is not a good sign. We want to see the tech leading the way, because where tech goes is pretty much going to drag the rest of the market with it. But it's not quite as strong as the overall broad market here.
So you mentioned Nvidia. We got to take a look at this. This is the poster child now for the NASDAQ. It's up 150% on the year. Not too far off its all-time highs. It's had a massive recovery from that low we saw back in August.
Yeah, I mean, I still like Nvidia. I mean, it had that huge pullback. I mean, that's enough to shake most investors out and lots of panic and almost 35% pullback. But overall, it is a very strong pattern. I mean, this is how the market moves. It trades sideways. It has a rally. It has a pullback. It usually has some type of shakeout where investors finally give up. And then, of course, once they bail out because they think it's breaking down, it shoots up for the next leg. And it's creating another one of these big pauses. And this definitely shook people out right into this area. Now it's trying to build a base. And we could see Nvidia continue to go higher. I mean, the CEO is saying there's insane demand, I think is specifically what he said, for their product. And of course, if that's the case, Nvidia is going to be going higher. And where Nvidia goes, pretty much the whole market goes, or at least the large major indexes are going to get dragged up with it. So While it's not making new highs, it's definitely building a launch pad, and it looks like this week it could really start to break and run higher. I think the overall equities market wants to break and run higher this week. It looks kind of primed and ready. And actually, if we were to just kind of take a look at the SPY or the SP 500 index over the last few sessions here, this indicator right here is our short-term 30-minute chart, and it tells us when the stock market is dipping into an oversold territory. It's usually when we see these lows, that's usually when bargain hunters step in and the market will start another leg higher. So the fact that we've got these lime green bars and it found support at this 20-day moving average, this is a very, very bullish sign. This market is primed and ready for that pop. And Nvidia has a very similar vibe. Nvidia's ready to pop as well in terms of the price action. And hopefully we'll see Nvidia really scream higher here and break out, which will lead things up. You can see if we zoom in on the chart, it just dipped into an oversold territory a few sessions ago, and now it's screaming to the upside. So these lime green are kind of like little market resets. People panicked out and they bail out. The shares become short-term oversold for a momentum trader, and then you usually see the market pop and rip the other way once it's spooked out short-term traders and investors.
Yeah, and I'm sure there's people trying to short this thing every day, and they're just going to get sucked in, and this thing looks like it just wants to rip. So we have to take a look at China now because we had massive news out of China a couple of weeks ago, and every one of those markets, the Shanghai, the Hong Kong, and the CS 300, they're all up like 20% here in a very short period of time. What's your take here? Do these markets keep going higher?
Yeah, I mean, I don't follow it too closely, but I'm never a huge fan of something that screams higher on massive volume based on news. I mean, obviously there's stimulus, but if we go and we look at the monthly chart, it's always really good to take like that 35,000 foot view. If we just kind of draw a line across here, we've got pivot highs, we've got pivot lows, we've got a lot of price through here, a lot of highs and lows tagging this horizontal blue line. There's a ton of volume that's traded through here since 2008. And really it's popping back up and it's going to be running right into this, what I would call a ceiling, a resistance zone. So I think most of the upside is done. We'll see. To me, this is chasing a trade. It's a news driven move. I'm not a huge fan of trying to chase bubbles like this and because they can reverse just as quick as they happen. But I would say, hey, most of the move is done. It's running into resistance. It's probably going to start to stall out here. But definitely we've seen life. I mean, when you look at it, like China is like the ultimate in stimulus. It makes like the US look like nothing. China just does all kinds of stuff to instantly fix major scenarios where in the States it's a slow dribble and they're trying not to upset everybody, but they support things. But China just like puts their foot on the gas pedal and does things that dramatically turns things or tries to turn things around. They've got a lot of issues over there, but I would say Chinese stocks have had their fast, easy run. If you didn't catch it, which would have almost been a fluke because it happened just on news and you can never predict when news is coming out. I would say most of that upside is done at this point. And if the Chinese market starts to roll over here or trade sideways, then it might slow down the overall equities market in general as well, because this is definitely muscling up some pretty big stocks and some heavy weightings.
I don't know if you saw that interview with David Tepper from Appaloosa, but he was on CNBC, I believe, last week, and he's all in on China, and he's pretty positive on the markets overall, and he thinks these two economies, the U.S. and China, together they represent 45% of the global GDP, and he thinks this is just going to propel things higher. So it sounds like you have a little bit of concern about China.
Yeah, I mean, I did this with a bunch of investors last week in a mentoring session. So we pull up all the major indexes, Japan and Germany and all kinds of different indexes. We all laid them together. We looked at the monthly chart. And when the U.S. economy goes into a recession, all other indexes go down. When they rally, they all rally together. I believe we're coming into a major market top. I think this stimulus plan is trying to kickstart things in China. But overall, they pretty much all collapse and go into bear markets together. So I'm not one to try and pick the one horse that might go the opposite direction as the rest of the market. I'd much rather just be like, hey, if the whole economy, global economy, is slowing and weakening, a pop like this is very temporarily. I think it'll eventually just get sold into. Again, it's a stimulus plan. It's manipulation. Manipulation and news-driven moves are usually shaken out and reevaluated after the momentum is done. A lot of people follow China, and these big stimulus plans definitely move things, but I believe we're coming into more so of a recession, a global recession, and this will just roll over and fizzle out as we work up to this 38 level, which is that major blue line across that chart. So I'm not really that bullish on it. I mean, the markets are still in an uptrend. We are long equities here. But if you were to look forward a year from now, I believe everything's going to be trading substantially lower.
Okay, so one of the things that's driving these global markets are interest rates, and every major central bank of the world has been cutting, with the exception of Japan. So why don't we take a look at the TLT? That's a good measure of what's happening with interest rates. And in the U.S., the 10-year has just gone from 3.60 up to 4% now. A big part of this move has just come on the back of these strong jobless numbers we saw out of the U.S. But what do you see here when you look at the TLT?
Yeah, I mean, there's a definitely huge move taking place in TLT. Like, obviously, we've seen a huge, massive correction in bonds with the huge rise in interest rates. But I believe the equities market more or less is starting to put in a major top and will eventually sell off. And usually when one asset class falls out of favor, a new one will rise kind of from the ashes. And so I believe the type of price action we have on TLT is indicative of a bottom. All of this stuff to me is, a year from now, I think we're going to be substantially higher. Overall, if we go into a recession and things get weak, the Fed's going to probably continue to cut rates. And I guess there's going to be inflation that's going to be the wild card of how much do they cut. But overall, usually we see the stock market sell off, and then we'll see the Fed step in trying to stimulate and start to drop rates. And of course, that will send bonds higher. So I think there's some pretty good upside potential, maybe 15, 20% in TLT to the upside over the next year or so. Obviously, it won't go in a straight line, but I believe I believe we're going to see bonds become that defensive play. We're actually seeing this more now, just in the last couple of months. Finally, bonds have gone back to how they moved the previous 40 years, which is stock market goes up, bonds kind of go down a bit. If stocks fall, then bonds tend to move up. So we're starting to get back to the way everybody's kind of used to how they move. Obviously, the last 3 or 4 years haven't been quite that way, but I think we've turned that corner and we're back into somewhat of the norm. So I like bonds. I do like bonds. The price of bonds, because I think rates will slowly drift sideways and lower, which means bonds will probably slowly rise and eventually rally.
So, as you mentioned, one of the big unknowns is inflation. And one of the things that's really been helping us here the past year is the price of oil. And it's been kind of hovering in between the $70, $80 a barrel. And but recently, with the hostilities in the Middle East, it has caught a bit of a bid. But what's your take on oil here?
Yeah, I mean, I'm bearish on oil. To me, the chart pattern is, we've got a sell off and we've got a pause, and usually this pause or this pennant formation is usually known as a halfway point. And so whatever this first leg down was measures where, the next one should go. So I believe we're going to probably see like $40, $45 per barrel at some point, which a lot of people say there's no way. But in reality, we've hit this $40 per barrel a ton of times going back over the last 10, 15 years or so. It's not that significant. In fact, we went negative. So I mean, you can't really argue anything anymore in terms of where price could go. So I do think that is probably going to be the case. Now, obviously, we have the wild card, the black swan of the Middle East, World War III going on, and if bombs start flying, then all bets are off. Oil will probably skyrocket. Gold will probably want to move higher as well. Typically, those two go up in sync during a massive war. So other than that, I do think most things are stalling out and weak. And I'm bearish on oil unless there is, unless bombs start flying around and oil refineries start getting hit. That'll probably completely make oil take off.
It's amazing with everything that's going on in the world that oil is hanging in where it is. And you got to wonder if we didn't have these hostilities and we didn't have the war in Ukraine, oil would probably be at 40 or $50.
Yeah, and I think the world has really changed a lot. I remember back in the Gulf War and all that stuff going on. It was such a different time. Now, I mean, when we hear war, we're all I'm picturing are all those tracers across the skies and jets and bombs going off. I mean, that to me is like that's obviously what I picture in my head as war. Now it's just like a digital and like, a digital war of zeros and ones and interviews and people bashing each other and people swapping trade policies, who can buy this, who can't buy that. So it's really, really different. I think if we saw explosions in a big way in terms of refineries on fire and all that stuff, it would probably dramatically change oil. But I think war right now it's very different. I think. I mean, I'm not in that space. I don't know it, but it's just not the same as what we picture back a long time ago when there was like really guns going off and missiles going off. So if those start to fly, I think oil will do what we're expecting. But I think people don't realize maybe how bad things are because it's all just information and we hear news all the time. So we're all kind of like pretty numb to like, oh, there's more tension in the Middle East. And I mean, we've heard that forever. So it doesn't really spark huge fear, in my opinion.
Yes, and the other big difference too is the U.S. is the world's largest oil producer now, so
Right. Yeah.
that's also having a big impact. And so, why don't we also take a look at Exxon, given that's the largest oil company in the world, or the largest publicly traded oil company. I can't get over the strength of this thing. It's a beast.
Yeah, I know. It's on fire. It's doing really well. And this is one of those warning signs when energy stocks are doing really well. I think ExxonMobil, I think people are definitely into energy stocks. They're doing very well. They're trading up near, all-time highs. There's even the energy sector stocks. If we were to go back using this monthly chart as well, it's up at levels that we've seen during major market tops or recession peaks. And a good view of that is if we go back to the stage analysis of the markets, there's these four stages of the markets. I believe we're in this stage three, which means after this, we go into a major financial reset. But if we go down and look at the overall stock market cycles, which is this blue cycle, we tend to see gold, like precious metals, do very well, which we are. Gold's hitting new all-time highs. Energy stocks tend to do exceptionally well, which they're hitting as ExxonMobil's new all-time highs. The energy sector space is up near all-time highs, and industrial capital goods. And all of these are early warning sign. I think, precious metals to me, like where gold's moving up, I look at gold as like the world is like a beehive, the whole planet. And so when everybody starts to buy gold, it's the whole mentality of everybody saying, okay, there's bubbles everywhere. There's uncertainty. People don't trust stocks. They don't trust currencies. And so they move to physical metals. That's a huge red flag that I think something bad is coming. Energy is more like there's some huge uncertainty in terms of war going on. So energy stocks are taking off, anticipating, oil skyrocketing because there's all kinds of, negative things starting to unfold. The in capital goods, all kinds of companies have had really good earnings. Manufacturers are upgrading their assembly lines, and they usually upgrade everything right after a strong business cycle, and then we go into a recession. So all those things are starting to show. And as you mentioned, ExxonMobil, the strength here is amazing. This is a very strong chart pattern. It's breaking out, it's rallying up, and it's got potential to want to keep on going. This is a very strong chart pattern, but eventually, when the stock market does start to top out, all of these will fall. Gold will fall, industrials, energy stocks, they'll all get hammered and clobbered pretty good. But right now they're leading the way, and it's actually a warning sign of the market's late stages of a bull market coming to an end.
Okay, so you mentioned gold a couple of times. Why don't we take a look at the gold chart here? It's up 25% on the year, give or take. Where do you see gold going?
Gold has pretty much made its run. So gold's got these massive super cycle waves. And really, if we were to look at the last super cycle that started in early 2000s to the 2011 peak and down into this 2015 low, we can carry that forward. And this kind of goes back to one thing we talked about earlier, which is Fibonacci tells us how much momentum there is. So we had this first run up, and then we had the pullback. And based on this power, we can gauge where it should run to next. And here is that 618 level. When you hit 618 and usually take a pause, we almost always run up. It doesn't matter the asset class. I find this works on absolutely everything. You'll run up and you'll hit that 100%. One is 100% measured move. So this run up is equivalent to this run up. And so we're pretty much there. And last time you and I talked, James, I was saying, hey, when gold hits like 2,700 or 2,750, I think we are bloody close to a major market top, because this is the 20-year chart pattern, or more or less a 12 or 14-year chart pattern pointing to where we should land here. And everything is unfolded exactly as we've been anticipating for the last several years. And now we're at this level, and gold's at all-time highs, energy stocks at all-time highs. All kinds of chaos is happening, wars happening. And this big, strong rally that we've got in gold is very similar to what happened. Let me just clear this chart. What happened just before 2008 financial crisis? We saw gold, after it had broken into a bull market phase, it paused while stock market rallied, and then everybody started to pile into gold. There were bubbles everywhere in 2007. Stocks were overvalued, homes were overvalued, all kinds of global concerns. And then the stock market took a correction and gold pulled back about 34%. Well, we've had the same. We had a new super cycle start. We just had a multi-year pause in gold while stocks skyrocketed for the last several years, and they're still going up. But now gold is doing what it did in 2007. It's outperforming. It's caught up, outperformed the stock market. And this is telling us the world knows something bad is coming, and we're probably going to go into some type of sharp pullback and reset before we see things go higher. I do think we're going to see gold 5,000 and change over the next several years, but I do think this whole move has played out. I don't think there's a lot of upside, much upside at all in the precious metals space, very little until it resets. And then obviously the wild card will be if there's like a full-on war, then gold could squeeze up and really shoot parabolic even higher. But again, as soon as that fizzles out, we're going to see gold pull back and probably have a 15, 20, or 30% pullback. And that would bring it right back down into this consolidation, which happens to be percentage-wise the same as this one here. It pulled all the way back down to the multi-year consolidation. So I'm really bullish on gold long-term. This whole thing has played out as even you and I have talked about over the last several months since we've been talking. And now I think we're at the point where it's like, okay, I'm stepping away. I'm not looking to really take advantage of precious metals at all anymore. Now I'm letting them cleanse themselves. There'll be a new opportunity to the upside, I think, after we have the markets reset.
So one of the big differences between what's happening now in the gold sector and what happened back in the early 2000s was the move in the gold equities. And we're really not seeing that now. And why don't we take a look at Newmont, use this as an example. Back in the early 2000s, the gold equities were trading at a big premium to their NAVs. And now there's very few names that are trading at premiums to their NAVs. When you look at Newmont, for example, what do you see here?
Yeah, I mean, it's a pretty ugly chart. I'm not a fan of something that's really just oscillated in big volatile ranges for the last 24 years. Overall, to me, it's a pretty ugly chart. It obviously has this is the monthly chart. It's had a very nice run. It is definitely stuck at resistance. If we were just connect these from a technical standpoint, usually you have a floor, a support level, but once you break it, it becomes resistance. We've just had a very strong move up to this level. And if I was to just draw a line right across here as well, you can see it's significant highs, significant lows, a breakout, a high, a couple highs, a topping phase. So Newmont is running into resistance, and it's definitely struggling. It actually, you can see on the monthly chart here, when we zoom into this bar, had a little bit of a run and push up, and then it's getting sold into. So there's sellers lurking up there. Again, not a whole lot of upside potential. Maybe it has a little bit of a squeeze up or something, a little shakeout. But overall, I think, the precious metal space is not really going to be that exciting until we go into a financial reset and everything gets cleansed. And we'll probably see gold stocks trading dramatically lower, back down the lower end of this range, probably down in the mid 20s or down in the 30 level. for Newmont, and then from there it could go into a huge run in rally. But I'm not a huge fan of this stock. I mean, obviously it's huge in terms of the company itself, but percentage wise, it's I think there's other places you could get into and trade without a lot of this chop and noise. I do like, GDX or any of the gold miner ETF baskets kind of as a whole. I find they're a little bit cleaner. When we look at the precious metal space, they have formed a much cleaner pattern in terms of they've put in like a rounding bottom here, a pretty major base through here, and they kind of broke through. Now they're sitting on top, finding this traction. I think there might be a little bit of upside, but overall, we need to wait for the stock market and everything to reset. And then I think we're going to see these really take off going forward. So again, everything is kind of waiting. We're in that wait and see mode. Long the stock indexes, the precious metal space, I think, has pretty much run its course for a little while. Let it reset. And then it'll be like all hands on deck when that super cycle comes into play, very similar to 2008, where we could see miners and everything really take off. And that's this is what we're waiting for. So this opportunity right here that a lot of us played, it's a life-changing move in a lot of gold mining stocks. That'll be like over here. I believe we're getting closer. And this is the monthly chart. So this could still be 6, 8, 12 months out. But we're actually getting very, very close to, I think, that type of scenario where we can get into the, any type of precious metal miner at that point.
So this is a better example of what's happening in the gold sector as opposed to Newmont, because this is comprised of a basket of stocks. But once again, physical gold is trading at all-time highs, but these gold equities are nowhere near it.
Yeah, they're just not participating. There isn't the light. Like, they've had a nice run, but in the grand scheme of things, like gold is trading to equivalent to like up here, and miners are way off. It's not the right time for them. And this is the problem with, a lot of people will follow one specific sector or asset class, and then they wait like a decade for them to come back to life. This is the problem. There's the windows where a specific asset like this come to life is very short. It only lasts a few years. If you catch those few years, they're life-changing in terms of financial returns, but you need to like step away and let them reset and build. And we're just not at that phase yet, but we're very close to them wanting to take action, and we'll start to see a lot of action, a lot of money start moving in, and that'll be a big flag saying, hey, it's starting to come to life, but we're not quite there yet.
All right, so gold's trading at all-time highs, but silver is nowhere near it. Let's take a look at the silver chart and get your views on that.
Yeah, silver's got a really nice looking chart. It's been moving up. I've been expecting it to go to about 34 to 36, somewhere in this area, bring it back up into these kind of highs over here. So silver, very similar to the gold miners. I find gold miners and silver are kind of same mentality. It's the same waves in fear. It had that kind of bottoming formation, more or less. It's kind of created that launch pad, and it's moving up now. It's a little higher than the miners because I find it's disconnected from the stock market. People are moving into silver, so there's still some more upside. This has got a nice little chart pattern. We still might see a squeeze up, but once it gets into this resistance zone where we've got significant lows, we've got a couple significant highs, three highs through here, this is going to act as a major resistance zone. So I do think we could still see silver and miners and gold have one more little squeeze and pop up. But I do feel like after that, we're going to see some type of reset and pullback. But silver, obviously moving up. I like metals in this situation more than the miners because they're disconnected from the stock market. So if the stock market starts to sell off, the precious metals space, they're a physical asset. They're outside of the equities market. They can actually keep moving up. And that's what we've seen before, where gold continues to rally and moves higher dramatically, while gold miners actually trade sideways because the stock market goes down. And as everybody knows who follows me, I look at the stock market like the ocean tide. When the tide goes down, all boats go down. So and when the stock market goes down, all stocks go down. So you don't want to hold gold miners, even though they're in a favorable environment. They're still a stock. They're a boat on the water getting pulled down with the rest. You got to get out of the equities and then go to physical silver or gold. They're the ones that can kind of drift and continue to move higher while their equities market is under pressure. And people don't want to move to gold because it's like, people who trade miners because they want the volatility. But the reality is you actually can make more with a really conservative play because it'll naturally buck the trend and want to move higher. Well, miners are subject to selling pressures in the equities market. But that's the problem. If you try and chase big returns all the time, believe it or not, some of the best returns are actually in the slower moving assets. But people just don't see that. They want the volatility. They want to try and swing for the fences.
Okay, Chris, I want to ask you about one more metal before we move on, and that's uranium. In my opinion, I don't think there's another commodity that has a more positive backdrop than what's happening within the nuclear energy sector in uranium. And when you look at the Sprott Physical Uranium Trust, or SPOT, what do you think of this chart?
Yeah, I mean, this is a really strong chart. Just using Fibonacci extension based off this last level here, we can get a gauge of where this could run. This is a super strong looking bull flag pattern. As a technical trader, a bull flag pattern is you creates a flag pole, so a move up, and then a flag usually flags in the opposite direction in the wind, flagging downward. And then here's the second half of this move should bring us up to 618 level. And then from there, it can run all the way up to 32. So 2650 to 3250 is the upside potential based on this chart. And from where that is, that's a 60% upside move, 61 potential if this was to unfold. Now, this is the monthly chart. So obviously this could take very similar to this one, which is a 1, 2, 3, 4, 5, 6, 7 or 8 months minus 2 here. So, in 5 months, it could potentially run up there. So it does have a very strong chart pattern, and it is pointing to higher pricing, and see if we can get some traction here.
The second largest uranium producer in the world is Cameco. It's based in Canada. Why don't we take a look at that?
Yeah, Cameco's got a little bit of volatility. I think the big sell-off we saw kind of this summer in the overall stock market created a little bit of a pattern I don't like, which is a broadening formation. You got higher highs, lower lows. It's known as a megaphone pattern. It just means volatility is increasing. It's rallying up, but it's to higher highs, but it's also selling off to lower lows. It's a sign of indecision. Increased volatility generally means the previous move, which would be this move up, is running out of steam, and eventually, it could roll over. So there is definitely a little bit of weakness in this megaphone pattern. It's much better when price consolidates into like a narrowing pattern. So it rallies up and then pauses and then breaks out. So increased volatility, obviously you need to be aware it's can probably continue to be more volatile. So you have to take smaller positions, manage those. I'm not a huge fan of this chart pattern. I like the other chart we just looked at, the Sprott one, much more than this, just because this at any point could sell right back down, or it might push up to higher highs. It just doesn't have a very super strong chart pattern. It looks like a sign of kind of exhaustion. That's not my favorite type of pattern.
Do you see a potential double top forming here?
If
it comes back up to that $56 level?
Yeah, so we'll just drop down to the daily chart real quick and kind of get a bit more of a granular look. Yeah, you could argue a few different things. Like you could say there's a shoulder and a head and a shoulder forming, and it's usually known as a major topping pattern, and it's got a sloping down neckline, which isn't good. It's hard to say. To me, this is a pretty ugly chart. I wouldn't trade this. I would look for a different uranium stock to trade, but it's definitely right up into resistance. It's had a very strong move. To me, it's just a kind of an ugly chart. I wouldn't trade it. I don't know what to do here. That's why I wouldn't touch it, is because it doesn't give you any clear direction. You're really just taking a stab at it, a total random guess of which way it would go.
So that's a good overview of the various markets. And in the last few minutes, Chris, I just want to spend a little bit of time summarizing what you think is going to happen here in the coming months. And you said you're bullish on the S&P and the NASDAQ here as we go into year end, but then come Q1, Q2, you think the market's going to top out and we're going to see a downward spiral. What's going to create this downward movement in the markets?
That's a good question. I mean, pretty much whatever creates it, we don't know what it will be until it happens. And then after the bear market, everybody will label it as something like, the tech bubble or the global financial, crisis. Um, I, Usually it's always the same thing. It's buying momentum has stalled. Sales for companies are starting to slow. People start to sell stocks. We're already seeing in the United States, people have burnt through their cash reserves. Credit card debt is skyrocketing. People can't pay them. Mortgages are going up. So to me, somebody always wants to throw a label on it. Everybody's like, what caused it? Everybody wants to know why. It doesn't really, I wouldn't throw one particular thing. I would just say we've had an incredible bull market. I think there's been a lot of different stimulus things going on. I think the cycle is just coming to an end. Things can only be pushed and stretched so far. And we're starting to see, all kinds of weakness in certain assets or certain economic data slowly starting to lose momentum or change direction. And so I really just think it's just a cycle. I mean, we go through these all the time, major cycles throughout the economy and the stock market. So I just think we're running out of steam. And once the things start to roll over and the momentum shifts directions, that's when things actually pick up speed, because now businesses are like, oh man, things have actually turned a corner. Businesses tighten up on spending. They start laying off and people obviously employment starts to go up. So it's just this whole string of things that kind of happen naturally. And we could say it's going to be some AI bubble or whatever, a COVID bubble has burst or whatever they're going to call it. But it really is just time has done its thing. We've all got super greedy. There's bubbles everywhere, and they just need to burst and reset. It's, things always get stretched too far in each direction, and eventually they kind of break and they revert to the mean or beyond and then turn around again. So it's just time, I think, in terms of what is doing it is just a cycle.
Well, I think it's going to be very interesting to see what companies are saying with their Q3 numbers. We had many companies during Q2. They came out and they said they saw a lot of weakness within the American consumer, and numerous companies, Starbucks, McDonald's, Nike, Airbnb, and Home Depot, and so many more. So I think that could be a potential sign of trouble right there.
For sure.
So, Chris, as we wrap up, I want to thank you very much for spending time with us today and sharing your thoughts on what's going to happen here in the coming months. If somebody would like to follow you online or learn more about your services, where can they go?
Yeah, they can follow me on YouTube at The Technical Traders, or they can go to my website, thetechnicaltraders.com. And I run through the markets every morning, pre-market. So people, before the market's open, you get a glimpse of what everything's doing, how it'll affect any positions we're in. I share my trades. I focus on just ETFs. Whatever I'm trading with my own portfolio, I share in detail with everybody else what to buy, how much to buy, our targets, our stops. And the videos are super educational. You learn how all the markets are interwoven. And when there's big days of panic, buying or selling, I'll be in there showing you how we can gauge and see this, and how each of those are actually very good indicators for us to take control of the markets and take advantage of people's emotional swings. So they can ride my coattails, copy my trades, learn how to read the charts at thetechnicaltraders.com.
Well, that's great. Thank you very much, Chris.
Thanks, James. Appreciate it. Take care.
Well, I hope you enjoyed that discussion with Chris Vermeulen and gave you some ideas on what might be happening in the capital markets in the coming months. As Chris mentioned, he's very bullish on the gold price in the long term. And if you would like to learn more about gold and how it can benefit your portfolio during these uncertain times, visit our sister company, hardassets.alliance.com. Hard Assets Alliance is a trusted platform that's being used by over 100,000 institutional and retail clients to buy and sell physical gold and silver. Once again, that's hardassets.alliance.com. There's a link below in the show notes. I want to thank you very much for spending time with us today. And if you have any ideas on who else you would like to see on our channel, please let us know in the show notes below. Once again, thank you.